Unit 2, Section 5. So we concluded by saying that when you are selecting a brokerage firm, the things that you should look at for are: one, the firm selected must be well known. It should be established for a long time. The firm should be able to provide research facilities. And the firm must also provide useful information. The firm must also have qualified brokers as employees. So last, this is a summary of Unit 2, Section 5. Then we also look at functions of a brokerage firm. They provide research reports on firms and industries. They give us economic forecast, and they also invest in management service. So these are the factors you consider when we are selecting a brokerage firm. So today we'll go to chapter Unit 2, Section 5, which is types of orders. Types of orders. Now, what happened is that investors give specific instruction to underwriters as to how they should handle their investment portfolio. So we are going to discuss this afternoon. Our objectives are, by the end of the session, you should be able to enumerate the various types of orders when it comes to trading of securities on the stock market. Distinguish between different types of orders. These are the objectives we are looking at. So please, let's start. Types of orders. There are different types of orders that an investor may give to his broker to execute in buying and selling of securities. For the brokerage to satisfy his client, these orders must be followed strictly. Some of the orders are discussed below. So the first type of order, which is 6.1, is 6.11 is market orders. Market orders are executed as fast as possible and at the prevailing market price on the exchange. It is simply buy and sell order. Which are to be executed immediately at the market price. For example, an investor might call his broker and ask for the price of ABC Limited. If the broker quotes the price as 50 cedis, meaning the bid price is 50 cedis, price is 60 cedis, the investor might direct his broker to buy 100 shares at market, meaning he is willing to pay 600 cedis per share for immediate transaction. Similarly, an order to sell at market will result in stock sales at 50 cedis. The advantage of market order is the speed at which it is executed. The problem with market order is that the investor may pay different prices for the same order. For example, if 50 cedis and 60 cedis, the investor who wishes to buy more may have to pay a higher price for the rest of the orders. Okay, so market order. This is where an investor will tell the broker to study the market. We learn about the various shares, derivatives that are sold at the market. So the broker will study the market, look at the price, then the investor will tell him either to buy the share or to sell the share. So what we have here is bid price and ask price. So let's look at the difference between a bid price and so you can hello. Okay, so you go to the market and you ask, how much are we selling? How much is this product? The person will give you an amount. Then when you bargain based on your skills in bargaining, a particular price will be agreed on. So we have the bid price and then the ask price. So the investor may ask the broker either to sell its derivatives for either at a ask price or at a bid price. Then our next type of order is limited order. In limited in limited orders, investors specify price at which they are willing to buy or sell a security. So with the limited price order, the investor give a price that the broker should either sell or buy a security. So for example, an investor may instruct his broker to buy ABC shares if and when the share price falls below 570 cedis. So you see, with the limit order, the investor instruct the broker, or the investor asks the broker to sell shares or to sell the asset that are traded at the stock exchange at a particular price, either to buy at a price or to sell at a price upon studying the market. Correspondingly, a limit to sell order instruct the broker to sell as soon as share price goes above the specified limit. A limit order with a price distant from the prevailing market price is said to be away from the market. The main advantage of limit order is that the investor has advanced knowledge of the potential transaction. It sets the boundaries of risk the investor is willing to assume. So please, with the limit order, here the investor give instruction as to how much each derivative should be either sold or bought, studying the market condition. Hello? Hello?
Hi.
Please, are you hearing me? Hello?
Yeah, yes, please.
Yes.
Okay, yo.
Hi, sir. We
Let's
can
go
hear you.
to time limit order. Time limit order. Orders can be limited by time. At the time the investor placed the order, the period for which the order is to remain in force is specified. There are different types of time order. We have day order, for example, expire at the close of trading day. Open or good till cancel, which is OTC order, remain in force until either executed or cancelled by the customer. However, it normally remains in force up to 6 months unless cancelled by the investor. As a matter of convenience to customers, a broker may accept an order for a week, month, or through a specified period. Okay, so the OTC order, the investor places an order and then he gives some specific period that the broker should go by that order. So we have the day order, which expires at the close of trading, and we have a open or good till cancel, which is OTC order, which remain in force for a maximum of 6 months. Now, our next type of order is a stop loss order. Stop loss order. Stop loss order is similar to limit order because the trade is not to be executed unless the stock price hit a price limit. Stop loss order to sell will be executed if the price of the stock falls below stipulated level. Similarly, stop loss order specify that a stock will be bought when its price rises above a limit. As the name suggests, the order lets the stock to be sold to stop further losses from accumulating. This order normally accompany short sales and are used to limit potential losses from the short position. However, stop order can be used to protect profit. Okay. The next order is a stop limit order. Stop limit order is evidence to overcome some of the uncertainty of the stop loss order. In a typical stop loss order, the investor does not know what the execution price will be after the order becomes a market order. To overcome this problem, an investor may go further to specify the limit price. An investor may fix a minimum price at which he is willing to sell, but go further and specify the price below which trading cannot be executed. For example, an investor may instruct a broker to sell a stock if the price falls below 50 cedis, but enter a stop limit to sell at 48 cedis. Nothing below 48 cedis will be accepted to the investor. The only danger with stop limit order is that the order may never be executed if the market moves downwards. This may result in huge losses. So with the stop limit order, the investor gives the broker a specific price that the broker should sell each derivative. So if the price that the investor gives is not met, the order will not be executed, or the transaction may not be executed. So for that matter, the order can be there for Eric. Eric. Hello, Eric. I saw your hand up. Hello.
Yeah, hello, sir. Please,
Yeah.
please, I can see your slide.
Yes, I'm having challenge with my laptop. So earlier on, I told your colleagues that today I wouldn't be sharing the slides. With all apology. So maybe you didn't join us on time. So to others, please, I'm having challenge with
Well
my.
noted, sir. Initially.
Okay. So please, let's go to unit 3. Unit 3, which is financial statement analysis. Since last semester, when you were in level 300, we did something like that. So we are going to look at this into details. Now, overview. Let's look at our objectives. Explain what a financial statement is. Outline the various uses of financial statements and the information needed. Outline the means by which financial ratios are compared, basis of comparison. Then explain the limitations of financial ratios as a means of analyzing a firm. Then calculate and interpret a major ratio under financial statement analysis. So these are objectives. And I'm sure at this level, we all know the major financial statement that we have. Our hello.
Hi.
Hello. Achieve Eric. Please, I saw your hand up. Share this. Hello. Eric, please ask your question. Hello. Please, can you hear me?
Yes, we can hear you, sir.
Okay.
Yes, sir.
So I'm trying to share the screen. Can you see the screen now?
Yes, sir.
So basis of comparison for analysis. So financial statement. Please, Nicholas, read financial statement for me if you can see the screen. Nicholas, if you can see the screen, read the financial statement for me. Or any of you who can easily see the screen should read the financial statement for us.
Okay,
Okay. Let's go.
the financial statement. The basis for financial planning, analysis, and decision making is the financial information. Financial information is needed to predict, compare, and evaluate the firm's earning ability. It is also required to help in economic decision making, such as investment and financing. A firm communicates financial information to the users through financial statements and reports. The financial statements contain summarized information of the firm's financial affairs organized systematically. Financial statements, into brackets, profits and loss account, balance sheets, cash flow statement, etc., are products not merely for their own sake, but to communicate economic measurement of and useful information about the resources and performances of the reporting company to those who have reasonable right to such information. Sir, please, should I continue? Hello, sir.
Statement, then tell an investor based on my findings, or after scrutinizing this financial statement, I think when you invest in this particular company, it will be useful. So please continue with users of financial statement. Continue with users of financial statement.
Users of financial statements. Okay, sir.
Hello?
Hello, sir.
Hello?
Sir, please, can you hear me?
Sir, we can hear you.
Hello, sir.
Yeah, yes, please.
Okay, sir.
I can hear you.
Users of financial statements.
Yeah. Yeah, we can hear you. Continue. Please, you
Okay.
can hear you.
One,
Continue.
owner or investor group. Okay, sir. Users of financial statements. These identified groups are the users of financial statements. One, owner or investor group.
Hello?
Existing and potential. Hello, sir.
So please, somebody else should read. I'm sure his network is having a problem. Madam Charlotte, read for us, eh? Okay. Hello. Please, I think he's having problem with his network. Mr. Philip, can you read for us?
Okay, sir.
Mr.
Please, since you stopped presenting it.
Ameye. Philip.
Sir.
Hello.
Hello, sir.
Sir, we can hear you.
Okay, so please, if you can hear me, let me read. These users of financial statement. These identified groups are I stop presenting it.
Users of financial statement. These
Hello.
identified groups are the users of financial statement. One, sir. One, owner or investor group.
Please, I'm
Existing
hearing.
and potential shareholders and
responding.
And stakeholders. Two, employee group. Existing and potential employee include management, trade, union, and past employees. Loan creditor group. Existing and potential debenture holders and loan stakeholders and providers of short-term security and unsecured loans. 4. Business contract group. Business contact group. Customers, suppliers, clients, banks, potential managers, and takeover bidders. 5. Advisors group. Economists, statisticians, researchers, investment advisors, management consultants, credit rating agency. 6. Government. Central government agency like IRS, SEPS, Price and Income Board, that is PID, and local government agency. 7. General public, community, political parties, pressure group, etc. Taxpayers, environmentalists. Hello, sir.
What are you reading for? We don't see. He's not online.
Oba, when he come, then he will explain to up to 7.
But where are you even reading from? Because he's not presenting and you are reading.
That's the users of financial statements.
But he's not
Users of
presenting.
financial statements.
Isaac, are you seeing the
I
projected
opened the
work?
book.
But he is reading from the
way
model.
you are doing, when they ask somebody to read and the person is not able, they will say you don't want to read.
No,
Tell
he's
him
reading
you are
from
not
the
seeing the
model.
thing so that he will be aware.
Oh, I'm reading from.
The screen
All
is
of us
off.
are not
the
having the
book.
model. We are not having the model. We are not seeing the projection, and you are reading.
I'm
Hello.
reading from the soft copy that they
Hello.
sent us. It's a soft copy that I'm reading from.
Okay.
Sorry, it's a soft copy that I'm reading from. That's the users of financial statement.
Let's continue. I said I have problem with my laptop. That's why today we are not sharing the screen. I'm trying to do my best just to get it, but it comes and goes off. So please let's just try to manage for today. I beg. So the one release you control, we are
Okay,
on
so
users of
sir,
financial
please, the
statement.
users of financial statement, we have, yes, we have read up to number 7, so we want you to explain for us.
Okay. So the financial statements that are prepared, we have people who are interested in them. One or investment group. So if a group has money and they want to go to the stock exchange to invest, they are also one of the existing, they are also one of the users of financial statement. So the group can also be there, or a group is planning to get. Then employees group. The employees, we have existing and potential employees, including management, trade union, and past employees. Business business contact group. When we talk about business contact group, we are talking about customers, bankers, and the like. Then advisor or analyst group. So we have the economists, statistician, advisors, consultation. Mute your microphone. Okay. The central government agencies like internal revenue, IRS, SEPS, price and income board, and then the local government agency. So these are some of the users of financial statement. Then the public, yes, the general public is also interested in the financial statement that the stock market may publish. Okay. Then types of financial statement. Basically, we have 5 types of financial statement. Types of financial ratio. Yes, we have 5 broad uh, types of ratios that we use uh, to explain or to break the figures that we have presented in our financial statement to the figures that we earlier on discussed. So we have stability ratio, liquidity / solvency ratio, activity ratio, activity or efficiency ratio, leverage or gearing ratio, then investment ratio. Evaluating the performance of a company by the use of various ratios will be less meaningful and beneficial unless a reliable and appropriate basis of comparison is defined. So we are looking at basis of comparison for analysis. Now, when you are analyzing a financial statement, what are the parameters that you are using to do your analysis? So one, a comparison over time, comparison with other firm, comparison with industry average, then comparison with budgeted ratios. So you can take one firm, you analyze the firm financial performance for a particular number of years. That's comparison over time. Then comparison with other firms. So if we are all in the hospitality industry, we are all in the transport industry, we can do the analysis, we can do the comparison of one firm against the other. Then we call something industry average. So let's say in the transport industry, in the hospitality industry, based on some past performance, they set up their average. For instance, a current ratio average should be this. So each industry may have their industry average. Then comparison with budgeted ratios. Yes, firms may draw a budget and then calculate some ratios down. So you can use that when you actually run off for a particular month and you want to check your performance. You can use comparison with the budgeted ratios too. So let me quickly run through this so I will go to the limitations. Comparison over time. One of the most useful ways in which accounting ratio can be used is to compare them with previous period ratios for the same organization. For example, in 1994, if 1994 ratios are compared with a trend of ratios from say 1989 to 1993 or a selected years ratio. It will clearly indicate whether there has been an improvement or otherwise. This is intra-firm comparison. Okay, so intra-firm comparison, the same firm, but you are considering different periods. Then comparison with, since I'm reading comparison with other firms. Since firms operate in competitive environment, it is always necessary to have some basis of comparison with other organizations, particularly those in the same type of business, operating in the same economic and political environment and using similar accounting policies. This is inter-firm comparison. For example, comparing the performance of ratio of Standard Chartered Bank with those of Barclays Bank. So the Standard Chartered and Barclays, they are all in the same industry. So when you are comparing their financial performance against each other, you are doing inter-firm comparison. Then I think here is okay. Let's come to limitations of ratios. Limitations of ratio. The first one, selection of appropriate basis for comparison is difficult as it may be misleading. Yes, let's say you are comparing a company in Tema. They all have their various businesses. So by those conditions prevail, of ratio analysis. You are analyzing a ratio in a company in a deprived area with a company in a city which has so many facilities. So that will serve as a limitation. Second, different conditions exist in one business in different years. Different companies may be operating under different conditions, using different policies and bases. This may make comparison difficult or may negate the usefulness of the comparison as a means of assessing potential performance. Okay, so existing different conditions in the various companies within the industry, but you are just using their financial to do the analysis, but I don't know the conditions that they are operating in. A company can have a light out for a whole week, whilst the other may be having light and then production and everything is going on. But when they prepare their financials, they can show this. So you will only look at the performance and then start doing your comparison and then give you a recommendation. So it is serving as a limitation to ratio analysis. 3, instability of price levels may negate the potency of performance ratio as a means of assessing operational performance and make interpretation of ratio unreliable, and unless adjustments are made for price level change. Yeah, so here each company, especially those into production and those who are into retail, their prices level changes based on the potential customers that they are dealing with. So some of these price level changes will affect their sales vis-a-vis all the other components. Yet an analyst will only look at the figures and give his or her recommendation. Then 4, many accounting ratios use end of period figures, which might not be true representation of actual situation existing over the entire accounting period. Unless weighted means values for the period are used, the correct picture may not come out. Yes. So you see, in ratio analysis, we normally make use of past records. So you are using your past records to tell an investor what to do in the future. Situation change. So the investor, based on your recommendation, may invest in or may use your information to take a decision that wouldn't help, because that past situation is not what it is currently prevailing in the stock market. Then, if ratios are computed on the basis of historical cost accounting figures, the result obtained and the interpretation may be variance with the current value and may not portray current existing situation. Yes, so you compute your ratios using historical cost concept. The concept says that you record your asset at the price that you pay for it for the very first time that you have bought it. So you use that to compute your ratios. But currently, how much is those assets that you have recorded at historical cost? How much are they selling at the market? See, so if you base your investment decision on this, at times it may be misleading. Then the sixth one, many ratios are computed from past financial statements and can therefore not be regarded as a reliable tool for future prediction unless a number of periods ratios are arranged for the trend to be discerned. Then the last one, the interpretation of ratio must take into consideration the existing circumstance and the nature of business and the nature of business. Otherwise, the interpretation may be misleading. For example, a stock of 5 times but not accepted to another. So please, can you hear me? Hello? Hello?
Yeah, we can hear you.
Hello.
Okay.
Yes, sir.
So the 5 ratios that are given, we are going to take them one after the other and then discuss them. Profitability ratio, that's page 59, profitability ratio. By the end of the lesson, you'll be able to, one, calculate the various ratios and the profitability ratio, interpret the implications of such ratios. So at the end of this chapter, at least you should know examples of profitability ratio such as return on capital employed, gross profit margin, net profit margin. Then you should know what the final figures are when you put the figures from the financial statement on your into your formula and you compute it. The final result that you will get, you should be able to interpret it to an investor to know that, oh, this particular product is very, very viable. Okay, so I'm reading profitability ratio. These ratios measure the degree of profit maximization in terms of certain values that contribute towards profit earning. Profitability ratios are of two types. Showing profitability in relation to sales. It measures the firm operating performance and indicates the earning power of the firm. It has different meaning and basis of calculation depending on how one defines capital employed. So our first ratio to consider is under profitability ratio is return on capital employed. And this ratio measures the overall performance of the company. Now, when you are handling this ratio, you should be very careful about how to define capital employed. Some firms define their capital employed as your working capital, which is your current asset minus current liability. Then you add the result to your net asset. That's after you have taken your depreciation from a fixed asset, you add the two, you get your capital employed. So capital employed is defined in different ways by different organization. So please, anytime calculation question is given, you take note of that. So we'll look at how some of the firm
Okay, Isaac, let's go.
Isaac.
Yes.
Hello. Am I the one I'm not
Hello.
hearing anything?
No, no,
Can you
no,
hear
no.
anything?
All of us. Oh.
Hey.
Are you using laptop?
I'm using my phone.
Oh, those who are using a laptop can share the soft copy so that you all look at it.
We even lost the man, so even we said the stuff. Okay, it's not the same thing. The man is not online.
We can read. We,
Ankara,
we can read when
Yeah.
he come. Then he has.
how you doing this course?
Yes. Who is asking?
Oh, Adams.
Yeah.
Okay.
Adam, share the screen for us.
Me- The screen.
The soft copy.
Am I the presenter?
Oh, at least it will help all of us.
But you are not hearing anything. If I share the screen grab by scores 90. You want to sell me, oh? You want to sell me, don't sell me. I can't share the screen. The whole of today you want to sell me. They will not buy me.
Sharing our screen is nice. Oh, you just share so that maybe we can
What
read
what
up to the
what
second point.
what if I want to do something? Hi, Master, don't sell me, it's okay.
Hey, Adam, you want to do what?
I'm not sure I want to do anything. Well, I say what if I want to do something?
Something like what?
Maybe I can want to I can go back and do something. So I want you to be seeing what I'm doing. So what
Hello. Hello. Hello.
Hello, sir.
Hello. Today the
Hello.
network is bad. Oh.
Oh, sir,
Hello.
we can
Hello.
hear you. Yes, sir.
So please, can you hear me? Can you hear me?
Yes, sir. Yes, sir.
Hello. Oh, Charlie, sorry. So liquidity / short-term solvency ratio. So the liquidity ratio just talk about how you can use your asset to satisfy your liability. How you can use your asset to satisfy your liability. So I'm reading. It is extremely essential for a firm to be able to meet its current obligation. This is
Sir,
because
please, sorry. Sir, sorry. Madam Rashida Baka, please mute yourself. We are struggling to hear him.
He said, hello.
Hello, sir.
Hello, madam.
I was telling Mrs. Madam Rashida to mute herself.
Madam Rashida, mute yourself. You are giving us a feedback. So liquidity ratio. It is extremely essential for a firm to be able to meet its current obligation. This is because the survivability or other ways of a firm depend on this. Liquidity ratios measure the short-term financial stability of a company and reveal its ability to meet its current liabilities or short-term obligations when they fall due. In fact, analysis of liquidity needs, please, can you see the screen? In fact, analysis of liquidity needs the preparation of cash budgets and cash flow. But liquidity ratios by establishing a relationship between cash and other current money to honor its financial obligation as when they
Sir, I don't know whether you can hear me.
fall due.
The network is really bad. Oh, Charlie.
So
Hello, sir.
if a
The network is really bad. Sir, the network is bad. We can hardly hear you.
First, of creditors. Hello, sir.
Hello, sir. Oh, go from phone. As a client, come and take me through it.
This network is bad and easy.
Seriously, today, dear, Yaboka, we're just wasting our data.
And yeah, easy. Sorry. Hello. Hello.
Hello, sir.
Please, can you hear me? Please, can you hear me?
Sir, we can hear you. Yes, sir.
Hello. Okay. So, explain how you can use your current asset to satisfy your current liabilities. So you have known as working capital ratio. It measures the general terms, the ability of the business to meet each short-term liability as they fall due out of its current asset. So the current ratio is calculated as current asset over current liability, all is to 1. Please, the current ratio is calculated using the ratio. We use ratio, we don't use percentage. So here the two is to 1 is preferred, but what is an ideal current ratio differ from industry to industry. So in the previous chapters, I did mention of the basis of comparison. We mentioned industry average. So this is the industry average for quick ratio. That's another example of what? Liquidity ratio. We also call it asset test ratio. So it indicates the relative amount of assets in cash or current asset which can quickly be converted into cash available to meet current liabilities. Liquid or quick asset assist cash and bank balance, debtors, marketable securities, all is to 1. So please, those of you with the manual, make the correction. So it's current asset minus stock over current liability, all is to 1. Okay. Please, have you heard me? So the next ratio, the ratio of 1:1 is preferred. So that is the industry average for quick ratio. 1:1 is preferred. But what is an ideal liquid ratio depends on the industry. Then the next one, acid test ratio. It indicates the amount of cash and cash equivalent available to meet current liabilities. It is calculated as cash plus cash equivalent over current liability, all is to 1. In computing of cash plus cash equivalents, stock and debtors are deducted from current asset. Okay, so T-test ratio, that's 0.14. Vulnerability ratio, it answered the question from which current asset shall we have the last CD or the PESWA to sell our current liability, beginning from cash to stock in trade, and what percentage of these current assets do we require? A firm with vulnerability of 60% of debtors is better than a firm with vulnerability ratio of 20% of stock in trade. Please, is there a question? So these are also examples of liquidity ratio. These are examples of liquidity ratio. Oh, somebody give me a message. The system can hardly hear you. Oh, Charlie. Yeah, I'm sure I have a message now. Hello. 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 Hello.
Hello,
Hello,
sir.
sir.
Oh, so sorry. Yes, one of you sent a message that you can hardly hear me. So sorry, so sorry. Please, can we go to the form ratio, activity ratio? Or is there a question to ask for the liquidity ratio? Is there any question to ask? Hello? Hello? Hello?
Hello, sir. Hello.
Yeah. Is there a question about the liquidity ratio?
Yeah, please, if you
If no
can
question,
kindly go over for us.
if I can do what?
If you can go over the liquidity ratio for us.
Okay. So I think that the liquidity ratio simply talks about how you have money available, how you have cash and cash equivalent to satisfy your current liabilities. That's all that the liquidity ratio talks about. Then an example of the liquidity ratio is current ratio. Current ratio. So we say generally current ratio around 2:1 is preferred. But what is an ideal current ratio differ from industry to industry. The higher the ratio, the more solvent. In the short, it indicates overtrading or holding of excess. So the satisfy or to honor current liability. That is what the current ratio measures. So we have been given a formula here as current asset over current liability, all is to 1. That's how the current ratio should be computed. Hello?
Hello,
Then
sir.
another example of current ratio is, yes, madam. Please, you can talk. I'm listening.
Oh, no, I was just
Hello?
wanted to. Hello, sir.
Yeah, madam, I'm
Hello.
listening, please.
Yeah, please. I wanted to get it right. You said the
Hi.
current ratio is calculated by current asset over current liabilities. All is to 1.
Yes, all is to 1.
Okay. Thank you, sir.
In generating revenue by comparing sales to different types of assets. This ratio measures the degree of efficiency in the use of the company resources to generate revenue and profit. Thus, activity ratio involves a relationship between sales and asset. The intent is to obtain the speed at which asset generate revenue. Its relevant ratios are, so please, when we talk of activity ratio mostly talk about utilization of our assets to generate sales, which vis-a-vis will lead to high revenue. So the asset that you are having, how are you utilizing them to generate revenue? If you're into transport business and you have fleets of car, how are you using this car to generate what? Revenue. That is all that the activity ratio talks about. So the activity ratio, we consider the relationship between our assets, how the asset is utilized to generate revenue. That is what the activity ratio basically means. And the relevant ratios and the activity ratios are stock turnover. It indicates the velocity or the number of times per period at which average figures of trading stock is being sold. So the stock of items that you are having, how frequent is it sold? And please, let's take note of this. Activity ratio result in number of times. Let's take note of that. Please, I'm repeating that again. Activity ratios final result are in number of times. Okay, so when we talk of stock turnover, what is the number of times that you sell that product that you have within a year? What's the number of times? Now, when I ask, if it is high, is it good? And if it is low, is it good? It's a debatable question. In the first instance, it depends on the commodity that the business is running or the type of items that are in the market. There are some items that customers can patronize very quickly. Others too can be there for ages.
Hello?
Hello.
Hello, sir.
Hello.
Hello.
Please. Uh, hi.
Hi.
Please, do you have a
Hi.
WhatsApp
Do
group?
you have a water?
Do you have a WhatsApp
Do you have a water group?
group?
No, please.
No, we don't have one.
I
No,
said,
we
do you have
don't
a
have. I
WhatsApp
said,
group?
do you have a water group?
No,
No, we need
no.
some. We have some. We need some. Yes. Yes.
How we utilize our assets to make sales, which will translate into very high volumes of profit. And the first issue under this is cost of sales over average stock. So our cost of sales from the income statement, and we get our average stock, opening stock plus closing stock divided by 2. Okay. Then the next one is hello.
Hello,
The
sir.
next activity ratio is stock turnover period. And that one is it replaces the average number of days, weeks, or months taken to 10 average stock. So we have average stock over sales times 365 days, or 52 weeks, or 12 months. So the question will give you which of the whether you are using years, days, or weeks, the question will give you. Please, reiterating the fact that the result of activity ratio is always in number of times. But here, with the stock turnover, you'll be having your result in number of days. Take note of that. Then, debtors collection period. It indicates the average period measured in months, weeks, or days, for which debtors remain uncollected. It shows the average credit period granted to credit customers. So we have average debtors times 365 days, or 52 weeks, or 12 months, all over credit sales. Please, the emphasis here is on what? Credit sales. Unless the question tells you to assume sales to be what? A credit. Where the credit sales cannot be found, use this is measured in the of each average
You
take the currencies to put in the
Isaac. Isaac.
Yes.
This silence all that we are experiencing there.
Sorry, it's no easy.
But please let the course give us his number, then you add us to the WhatsApp group. Hello.
Hello.
Yeah, I'm suggesting we should take the course rep's number for WhatsApp group.
Is it the general course
The-
rep or center course rep?
No, I mean for this particular course.
Course. Isaac. Isaac.
Adams is there. Adams.
It's a fail. Is he even online?
Yeah, he's online.
Adams. That Fulani boy is not here. He's there.
If you have the WhatsApp group, then add the lecture. Maybe when we are going to do the presentation,
Danny.
Adams.
My network is no good.
So by your key numbers, yeah, so that you add them to the platform, or you create a WhatsApp group for this particular course. Okay.
Who will create the group?
You were.
For our center or?
No, for this particular course, for investment management.
Oh, okay.
You said the lecturer was asking us if we have a general platform.
So Adams. Once we are all here now, ask of other centers if you can get someone number from each center. Then when you are done, then you send it to the person so that they will all join.
Okay.
No, my center, I'm the only one there. So I just wanted this number, then I WhatsApp me.
Okay, then Adam, give your number to him.
Okay, hello. Like
Hello.
Hello, Fiasman, we are 10. So I think I have Adam's number. So maybe I'll send him hi so that when he's done, then send it to me, the link to me.
Okay, that one was also good.
But I don't have any of your numbers.
So Adams will give his number to Adams. Collect the number. Please send it on the page so that
I am asking. Is this course for accounting students or marketing students also?
Chat so that you can.
If you call it, let's write it there.
Please